Hi, and welcome to our friends across the pond. This is Michelle Schneider, Chief Strategist of MarketGauge.com, with your weekly update on all things U.S. stock market. And what you're looking at right here in front of you is obviously the big news, which is the CPI numbers that came out. Now, the Federal Reserve looks at the CPI numbers, of course, but it is not the most important indicator they look at. They actually prefer the PCE, the personal consumption expenditure, and of course they look at the labor market. But on the heels of the huge news last week about Silvergate banks and Silicon Valley Bank and those collapses, we've had some bailouts coming out here today with government money coming in, and also a really good short covering rally after things got a little overdone. So the market is signing a big relief as I'm speaking to you, but I wanted to kind of go through here because there was the 6% CPI number generally, and then the core CPI number that actually showed an increase. And I think what's really interesting is how we have a 12-month adjustment. Here's the 6%, right? But it's 9.5% still food at home and 10.2% food away from home. Energy still looking really high. Energy commodities, though, have come off a lot. And one of the biggest declines was in used car and trucks, which is very, very interesting. But yet one of the biggest increases here was in transportation services. So I think the takeaway from all of this is, even at a 6% inflation, yes, that's certainly a lot better than a 6.4% inflation rate, but it is still a very high inflation. And in terms of the yields, even though the yields initially came down a lot with the bank debacle, they've actually been firming up as I'm speaking to you today. And that's because really with the Fed meeting coming up next week, we have a situation where the Fed will most likely stay the course because they'll feel they still have work to do in inflation. They'll probably look at the bank thing as more of a one-off situation as opposed to, let's say, a precursor to any other types of debt crises, although that could easily happen. And three is that the labor market, at least on the last unemployment numbers and looking at it, it actually shows still a relatively robust labor market with labor participation actually going up instead of down. So it's really going to be a matter of the chicken or the egg. Does the Fed break the back eventually? And what we saw last week with the banks was just a stress fracture that could get worse. Or is the Fed actually, regardless of the criticisms and all of the news that you see all over the place and the noise, actually accomplishing what they're trying to do, which is keep the economy from falling out of bed and at the same time breaking the back of inflation? Do I think we're going to get to 2%? No. But do I think that perhaps either scenario is equally possible? Yes, which of course makes investing now really more about what has the best momentum, how to think more actively as you're trading, and really still respecting the fact that overall we're seeing the indices, especially as we look at the SPX, in a trading range. Okay, so we always like to look at the weekly charts of the economic modern family, and what you're not seeing here is Bitcoin, which of course has been the big news as it cleared 26,000. Now it's back below as I'm talking to you, but there was a tremendous flight to safety as far as Bitcoin is concerned. So for the rest of our session today, what I'd like to cover is, first of all, I've been asked to look at the weekly petroleum report along with the natural gas storage, since we've talked so much about oil and gas. Take a look at the actual sectors that are outperforming. Take a look at the bonds, both the long bonds and the junk bonds. And also, I think what's very interesting is it's time to keep an eye on the gold to silver ratio. So that's where we're going to go for today. But if we start here with the economic modern family, obviously last week we saw the big collapse underneath both the 50 and the 200-week moving averages. We've gotten some support here at 60, What's interesting to me, and what's going to make it very hard to get overly bullish at this point, is that we have a double top here up around 75. And if for some reason we cannot get back up through at least 64, 65 in the retail sector, and we start to break down under 60, we have a monthly moving average close by. And of course, any kind of real move under 57, then this would mean that we could actually see another big leg down in the consumer area. And I don't care what's happening in semiconductors, even with it being relatively strong, that will come and put pressure on all areas. So we don't know yet. It's smack dab in the middle. In terms of the Russell 2000, same thing. That took a big hit, actually started showing signs of stress even before the SPY did, for example. And here you can see we're getting close in terms of a negative slope in the 50-week to a potential death cross, which would mean this would be put back into a bearish phase. And if we just blow it up for a second, we have not been in a bearish phase in IWM since back here in 2020. And we came out of it, obviously, in COVID. So people keep comparing this to the COVID time, but the truth of the matter is, what we're really looking at is the opposite of COVID. This is breaking down as other areas are starting to break up, like semiconductors, for example, along with the retail sector, which tells me that we are not out of the woods at this point. So, as I said in the beginning, active trading best. Now, would I change my mind if this cleared back over the moving averages? Well, I at least would think that we're going to see more of a relief rally. And the fact that we're seeing one right now is also obviously a good thing. 170 would be the breakdown number. Now in biotechnology, we broke also everything, and now we're right back with an inside week because the range of last week was just huge. Now what's interesting to me about biotech is that, as I've mentioned to you over and over, it's a cyclical and a non-cyclical. So the fact that people would run to certain biotech stocks probably would not be the worst idea when things are bad. And of course now we have a really good point at around 120, whatever this low was, 120, figure 120, 121 to hold. And I would think that if we can get and hold over these levels and we get back over, let's say 130, then that's a good sign for that area. And I would start looking for certain biotech stocks that have been underperforming. Teva was one of my favorite ones, but there's quite a few. PCBX is another one, and I'll show you the chart of that in a moment. So the other thing here now as we move down is the semiconductors throughout the whole bank debacle never broke down under the 50-week. It still has a negative slope. And how often have we seen semiconductors outperforming? We have chip technology happening in the United States. Obviously, we have AI, all the rage right now. And of course, technology will always be relatively outperforming because of the future of digital technology. But the question right now is going to be, can this hold above that 240 level? Right now it's at 243. Will this continue to go up? Or if these things turn down, will that put further stress on this and we'll start to see it break back down under 240, in which case we'll have to take a look and see what happens closer to 220. The third of the triage of the U.S. economy is the transportation stocks. Now, it did hold the 200-week. It's sitting right below the 50-week, but this too had some big topping pattern up around 250. So I guess we could really say is just like I was telling you 2 weeks before what happened with the banks, that the KRE regional bank sector was starting to show stress as it was breaking under the 50-week moving average, and then of course here we are. 50 is going to be very pivotal. We could also say on the opposite, if we really want to get more optimistic, then we at least want to see transportation or IYT sector close this week above 226. Then I would say that whatever happened, the optimism going into the Fed meeting is there, and things are better under control in terms of the U.S. economy. We'd still have to watch consumers, of course, and the banks and the Russell 2000. But this would mean most likely that semiconductors are continuing to go way up. Now, I said I was going to give you one biotech stock that I've been watching, and that would be Vaxcyte. It's still obviously underneath all the moving averages here except for the 200-day, but you got to go out on time frame, and after we had this big gap up, all we've really done after making new highs is work with inside the gap, which puts it in a situation, I would say, with a risk of around 35. So that's something to keep an eye on. If that continues to do well, let's say it gets back over 40, you have about a $5 risk on a stock that trades on an average of about $2 a day. Now let's just take a look at the SPY chart, because this is where we're going to get our monthly chart here. And you can see that that 23-month moving average continues to be the major resistance. And we're sort of smack dab in the middle. So again, we're going to watch that 390. 390 was great support. And now, of course, 390 is going to be, well, it was pivotal resistance, didn't last very long as resistance, and now it's going to go back to key support. And then, of course, we'll look at 4,000, and then really the big one is going to be what happens at the 23-month. We go to the weekly, though, you can see it's back down under the weekly moving average. So I would say that, again, optimism came in with the CPI report, but we're rallying towards resistance here, and I wouldn't get overly optimistic at this point. Just remember that this is a very much sensitive to a trading range market. Okay, so now let's move on to looking at the gold market, the bond market, and then, of course, looking at the oil and the gas market. So starting with a look at the long bonds, we had talked about this island bottom that happened here back on March 2nd, how it gapped up, leaving, you know, pretty much a good point not only to risk from, but also a kind of a precursor, again, along with what we saw in the KRE chart, that something was amuck, because when the bonds are going up and the yields are falling, that could be good news to a point, but it could also be signs of some type of a recession coming. Did we avoid it or not? Again, we don't know. But also so typical is that it then continued to gap above the 50-day moving average and then the 200-day moving average, but it closed below it yesterday. And now here we are sitting right back on the 50-day moving average. So we're not getting a lot of information other than the fact that when you have TLTs outperforming the SPYs, generally that is more of a negative sign for the market. And as far as momentum, we've been in a bullish momentum in that the 50 is over the 200. But you can see, and it's over the 50, it never quite got a mean reversion to the downside. In other words, it didn't take out the Bollinger Band and then fail it. So we're seeing some relief in terms of the yields going back up and the TLTs falling, but it's not decisive yet. And that is exactly the theme here, is that I don't believe that anything at this point that I'm seeing anyway is decisive. So we head to the junk bonds now, and the junk bonds are super important because this is the high yield, high debt bonds. Now we've held 90, give or take. We're back over 90, that's going to be key. This is outperforming the SPY, which is a positive sign. It did not have a mean reversion to the upside or the downside. However, it is obviously well below the 50, so there's no diversion between the price and the momentum. And really, at this point, we have to say, here was the low back in 2022, down at 88.60, which we're not even anywhere near. And of course, our moving averages, as the 50 is starting to overtake the 200, are way up here at 92. So it's a huge range to be looking at, but if we scroll this up a little bit, this could either look like a double bottom or higher lows, or it could also look like a giant topping pattern. Again, this is a very uncertain type of scenario here. The fact that we may be getting a golden cross with price both below was interesting. The fact that it's outperforming is interesting. If the momentum goes up too, along with the price, then I would have to say probably more of a risk on. Now I want to take a look here at the just the gold prices in general. And with gold right now, we cleared the 50-day moving average. We're getting some consolidation. The gold prices are telling us more, again, on the risk-off side, because they're saying, even with all the happiness that we're seeing in the market today, let's keep gold firm as a safety play. So here you are, well outperforming the SPY. Momentum took out the 50 at the same time the price did. And gold in and of itself, you know, it had a mean reversion here. It didn't really do anything though. This is why you have to look at all the things until it had sort of this inverted hammer doji, which basically means that it was the people were forcing the selling here, and with this type of inverted doji, which means the opening and the closing price are close to the same. When it's an inverted doji hammer, it means the hammer's at the bottom, and generally that tells you that there's forced selling pressure. Of course, we saw the next day, this was the day that we added to the market, and now you can see that this is going up and holding. So keep your eye on gold. But what I think is even more interesting that I want to show you here is the silver to gold ratio. Okay, so this is silver. Silver is still well underperforming gold, right? Had the same kind of inverted doji hammer here. You know, this has been a situation in the metals was when they look the worst is probably the best time to buy. When they look amazing, it's time to sell. But right now you're getting an inside day digesting these 3 days of bigger moves up, and we still have a very large resistance area looming at the 50-day. But here's what I'm watching. So right now, the ratio between gold and silver, historically when it's over 80, generally means that the silver is starting to come back, showing that it's grossly undervalued compared to gold. Since we're using a leadership of gold here, if it clears over this red line, then it's going to tell you that the silver is starting to overtake the gold. And I think at that point, silver would be a great investment to make if you haven't already. It also had a perfect mean reversion in momentum in that it held the 200, broke down under the Bollinger Band, cleared it through. And we could also take a look here at the 50-day moving average in our real motion indicator, which is available to everyone and works on every single instrument, no matter where you're trading in the world, by the way. And if it takes out the 50, at the same time it takes out, let's say, the performance here versus the gold, even if we don't get there in the price, all of that tells me two things. Number one is that inflation is still very much a problem and will continue to be so. It just will shift in terms of where. And number two is that the silver is so undervalued. Like I said, it'll be time to buy silver and see where that can go. Does eventually get through all these levels right here. And of course, we're looking at the ETFs. And to end, let's take a look now at the natural gas. So the weekly petroleum reports come out every Wednesday. So the one that I'm going to talk about right now is from last week, and March 15th will be when the new one comes out. But there was less input in terms of the oil in the refineries. The gas production had decreased. However, imports increased, inventories decreased, and gas prices rose. So a lot of the times these inventory reports are interesting, but they're mostly lagging reports. This is why I like to look mainly at the charts. And of course, probably the biggest plus for the inflation narrative is that the oil prices have come down, and yet it very much also in a range. So you're still looking at around $67 a barrel, and if we look at the USO as any kind of lead indicator here in terms of the ETF, 62 is your really big support, while we haven't really been able to get through 70, let alone 72, so we're just going sideways. And it's slightly underperforming the SPY again. And in terms of momentum, we didn't quite have the mean reversion, but you can see the momentum is going down back under the 50, so it's matching the price. So right now, it's been suggested that oil prices going down, not only obviously good for the consumer, which would then of course support the fact that we have to watch how transportation and XRT, the retail sector, does to see if we're really going to be getting out of the woods. And at the same token, it could also be good for gold miners. So that's a theory I've been hearing, as a lot of the mining was expensive because of high energy costs, and if the energy costs come down, of course that would be good for the miners to come back and start doing more mining. So here we are. Now, if we take a look at the natural gas prices, again, this was something that I featured a couple of weeks ago when I saw this not only oversold condition, but a good reversal pattern We got a nice pop, and since then we're just kind of sitting here right smack dab in the middle, and natural gas is slightly more on par with the SPY right now. To me, what's most interesting about this is the momentum. The momentum tried to clear the 50 here, but didn't last. If the momentum clears the 50-day moving average here, look at the divergence we'll have in price. You could simply wait for the 50, or what I probably would say is that if you get a close in UNG, if you're not trading futures, of course, then you would be looking at a buy, let's say, over 890. Now, when you look at the natural gas prices, that would be about a move over $3, and that to me would be very, very good. You know, the natural gas storage is within the 5-year historical range. Last week the storage was down while the stocks were up. Again, I think these numbers are important to look at, but not necessarily the end-all be-all, because the chart sort of tells you in advance. So to sum up, trading ranges still persist. Semiconductors are leading, but we want to see transportation in the game as well, and then most likely we'll see the Russell 2000 and retail catch up. The bank debacle may or may not be some kind of a harbinger of stress fractures in the overall system. Inflation has cooled, but core inflation is still high. The gold and silver ratio is telling us, though, to not be too complacent. And I think those are our big takeaways right here. Obviously, we're looking so much at the banks here in the U.S., and people have sort of stopped talking about the geopolitical risks, but they're out there as well. So hopefully this information was valuable to you. You all have a great day. Thank you so much for watching, and bye for now.